post it up to, excuse me, e-learning here in the next day or so. Okay, good. So let's go ahead and let's jump ourselves and take a look at the PDF for chapter 6. And now I don't want the update. And put it in full screen. And let's take a look at some of the potential point value. Now, what we're going to start to get into today are statements for standards for accounting and review services. And we talked generically some very basic things about those in the first module, but then we start talking about specific types of engagements that are contemplated under the statements for standards for accounting and review services. And basically all of these, okay, constitute 5 points. Okay, so this is a heavy area. Okay, we've got 20 points on these types of engagements, essentially preparation, compilation, and then reviews. And when we look at reviews, we'll look at them both from the standpoint of a full 12-month review versus a period of less than 12 months, which we call interim reviews. Typically, what's done there is a quarterly statements get reviewed. These last parts that sort of catch on, they give us an awful lot of pages here for something that constitutes about 3 points. And I am going to ask you to just go straight to the multiple choice questions and learn from working those multiple choice questions on that material. There's not a whole lot here on these ethical requirements of the SEC, PC, AOB, GAO, Department of Labor, AICPA Code of Conduct. Meanwhile, they've got 30 pages or so here. So you're best off just learning from actually going through and working the multiple choice questions and working the final review material that we're going to look at for this material. I don't even think you really need to spend the time watching the lectures for this because they go on a bit and it's not a heavy area on the exam. Okay, so let's see what we can get through tonight. Again, if we finish all of this first 6 modules, that's great. If not, we'll take a good chunk out of it and then we'll finish up chapter 6 next time and we'll jump ourselves into the final review next time. Okay, now you come over and when we're looking at the level of service, what's contemplated here is we're talking about looking at historical financial statements, okay, reflecting what has already occurred. We talked about prospective financial statements in the last chapter, talked about how some engagements do fall under the SARS, but now we are solidly in the area where we're looking at historical financial statements, but the level of service that we're providing to those financial services is less than an audit. Okay, so an audit is a what? Is a positive assurance examination in which we say, in our opinion, etc. Okay, so a couple of things, and through most of the book here, we've been talking about the procedures that support that opinion. Okay, the couple of things to focus on here now is going to be what is the level of service that's provided, what kind of assurance, if any, is given, what kind of report, if any, is given. That's really where we're, and then what level of work do we have to do to support that assurance, to support that report. So when we look at these 3 types of engagements, we have preparation, we have compilation, and we have review. Okay, now let's just first at a high level put next to these what happens with the preparation. There is no assurance. We provide no assurance. There is no report. No assurance, no report. Okay. With a compilation, there is no assurance. However, there is a report. Okay. And you say, well, why would someone choose a compilation over a preparation if neither of them have an assurance? Is because whoever the users are for the financial statements have at least asked to see some reporting from some accountant, and so the client ends up needing us to do a compilation. With a review, there is negative assurance. And remember, we talked a little bit about negative assurance, and we're really going to start to get into it more tonight. but we talked a little bit about negative assurance. Negative assurance is where the accountant says, I am not aware of material modifications that need to be made in order for the financial statements to be in accordance with whatever the applicable framework is, probably US GAAP in most cases. Okay, well, what's happening here, we're giving negative assurance as opposed to the positive assurance that we give in an audit, where we say, in our opinion, the financial statements do something. So what the CPA is telling you with negative assurance, the accountant is telling you with negative assurance, is what they don't know. They're not telling you what they do know. They're saying we're not aware of something, okay? And we do have a report, okay? So at a high level, preparation, no assurance, no report. Compilation, no assurance, but we do have a report. And for a review, there is a negative assurance, which is significantly less than the positive assurance we get in an audit, and there is a report. Okay, now let's just take a look at some of the things they say here. The objective of the preparation engagement is to prepare the financial statements in accordance with a specified applicable framework. Okay, now they tell us that it provides no assurance, and is considered a non-attest service. Therefore, it does not require determination of whether the accountant is independent of the entity, and there is no report, which I've already told you. So flashcard that last part there, that there is no assurance. It is not considered, it is considered a non-attest service, and therefore it does not require determination for the accountant to be independent of the entity. Now you take a look at a compilation. In a compilation, the objective is presented in the form of the financial statement, information that is representation of management without giving any assurance. Okay, so a compilation does not provide assurance, but because a report is required, it is an attestation engagement. And although we are not required to be independent, we have to determine if we're independent. Determination of independence is required. So flashcard, that last part, it does not provide an assurance, but it is considered an attest engagement since we do issue a report. Okay, and then with a review expresses negative assurance. They say limited assurance, and I get a little annoyed by the fact that they use that limited assurance, because all assurances are limited. Positive assurance is limited. It's limited to what? A reasonable level. Okay, so I don't know why they just say limited assurance instead of being more specific and saying negative assurance on the financial statements that have not been audited. The objective of the review is to express the limited negative assurance that there are no material modifications that should be made in order for the financial statements to be in conformity with the applicable framework. And then a review is based on inquiry and analytical procedures performed by the CPA. A review is both an assurance engagement and an attest engagement. Therefore, independence is required. Even though you're giving a lower level of assurance than you would in an audit, you are still required to be independent. Okay. Okay, so you can see the different levels of service here and some of the key takeaways there. And then if you perform more than one service, then you should issue a report for the highest level of service provided. So what happens if someone asks you to prepare the financial statements and issue a review report? Then you would issue a review report. You wouldn't have to issue a compilation report in that case. There is no report of preparation. But if you prepared the financial statements and then you also reviewed them, then you would have to issue a review report. You couldn't say, well, I don't have to issue a report because I prepared the statements. Preparation doesn't require a report. Yeah, but if you went further and you also reviewed those statements, then you issue the review report.
I have a question. How can you prepare the financial statements and then review them? Because isn't that a lack of independence because you're basically reviewing your own work?
Not necessarily. They give us information that we use to prepare the statements, but that doesn't mean that we can't do some sort of analytical procedure that would support the information that they're giving us. So they're saying revenue is $1 million, and they're in an industry where revenue of $1 million is ridiculous. We should be able to identify that through an analytical procedure like comparing them to industry. So no, it doesn't violate the independence to do a preparation and then do something to substantiate the information that they give you, right? In a preparation, they just tell you, here was our revenue. You don't sit there and make all the journey. I mean, you could, but it's still based on information that is the representation of management, right? So they could tell you anything in a preparation and you just put it in there, right?
Mhm.
And if you want to go further and do something to corroborate what they put in there, you might start doing analytical procedures such as looking at a comparison to industry standards, whatever.
Okay. But you couldn't do a preparation and an audit, for example.
Not of a public company, but you could of a non-public company, yes.
Okay.
Again, you would prepare the statements and then you would continue on, public companies, PCAOB said, well, hang on, Tiger, we're not going to allow you to do both of those. But under auditing standards, yes, you could prepare and then audit those statements because, in a preparation, again, they tell you revenue is $1 million. They tell you accounts receivable is $1 million. You put down accounts receivable $1 million. That's all. That's what you do in a preparation, right?
So because you're relying just on, you're taking the numbers they're giving you and you're not doing anything to the numbers until you take the next step to either review or audit it, right?
Correct. You're correct. They're giving you the number. You're using the number to prepare the statements. You're putting them down in the form, the form that is required of financial statements, right? Because we're an accountant. Then, if I want to audit them, I would send out confirmation to whatever they're saying, the outstanding account receivable. Now I'm auditing.
Okay. All right. Thank you.
Okay. Yeah.
That was confusing to me.
Yeah. No, it is confusing. When I did back in the olden days, you had to do in order to get your license, you had to be able to do an audit from beginning to end. You had to show that you could do the entire audit on your own. They called it a demonstration audit. So the engagement that I got put on was the House of Representatives Child Care Center. So I had to audit that from beginning to end. It was an entity small enough that one person could do it. So I go and I asked to see their general ledger, and it's an Excel spreadsheet. There is no general ledger. And I'm like, how the hell am I supposed to audit this? They don't even have financial statements. So what I did was I got a general ledger software package called Pacioli at that time. And I went through and I made journal entries for all this nonsense that they had kind of grouped into different accounts on this Excel spreadsheet. I literally did journal entries for them. And now I had financial statements to audit. So I prepared the statements and then I started the audit process. Now, of course, you still need to get a representation letter from management in which they take responsibility for those financial statements. So even though you're preparing them, they still, in an audit, right? We're talking about now, if you're going to do an audit, you may prepare the statements, but you still need a rep letter from them in which they take responsibility for the financial statements, which is an audit procedure, right? So that's how you cover that.
Okay.
Okay. Now, for public companies, the rules are a little different, though, but they don't want you to do that. Okay. Now, and that shouldn't be the case. I mean, public company, by the time they've gone public, should have a full-time controller and all the things that we're expecting a public company to have to be able to even get file registration statement with the SEC. So S1 statement with the SEC. They're a full staff at that point. Okay, good. Now you come over and just talking generically about the standards that we use for these engagements. and they are called Statements on Standards for Accounting and Review Services. They come from the AICPA, Accounting and Review Services Committee, and it is applicable, okay, to an accountant who is engaged to prepare, compile, or review unaudited statements of a non-issuer, and you should comply with the SARs. Okay, now the reason they say unaudited is because what? Well, we're going to be preparing, we're going to be compiling, we're going to be reviewing under the SARs. When you start to audit the non-public company, then you should flip over to the Statements on Standards for Accounting and Review Services. Okay, now what happens if an accountant breathes on the financial statements? Do the SARs automatically apply? No. They tell us that there are some services in which the SARs do not apply, such as preparing a few adjusting or correcting entries, consulting matters, preparing tax returns, rendering manual automated bookkeeping or data processing services, and processing financial data for clients of other accounting firms. Okay, so just go ahead and flashcard the nature of services in which the SARs do not apply, but be careful. Once you start to get into what is considered a significant amount of adjusting or correcting entries, then the SARs do apply. So a few, like maybe you're just recording the depreciation for them, okay, the SARs don't apply, right? Maybe you're just helping them to figure out what needs to be in the allowance for doubtful accounts and bad debt expense, you know, and that's all you do, then the SARs wouldn't apply. But you start doing a series of those kinds of things, then the SARs would apply. Okay. When we deal with reviews, and we'll look at reviews of both public and non-public companies, and you're doing an interim review, okay, and we'll look at this for both public and non-public companies, then the SASs apply if it's a non-public company. If it's a public company, then we will follow PCAOB if it is a public company. Okay, and the reason they do this, they start pulling interim reviews under the auditing standards because nobody has an interim review and they're going to stop there. Generally, if an entity has an interim review, there's also going to be what? An annual audit that goes along with that. So the standard setter says, okay, since we're heading towards an annual audit, let's go ahead and pull those under the standards for, for auditing for non-public companies, the SASs, for public companies, PCAOB requirements. Okay. Now, just some basic things, guys. I don't know. I'm going to look at this. I feel like this is like, yawn, this should be played on the Who Cares channel on Sirius Radio. They have a channel where they play a bunch of stuff that nobody cares about, and this would run every 5 minutes. Okay. So it's a three-party relationship in these engagements. So you have management. They are responsible for identification of the applicable framework, the design and implementation of accounting control. You have the accountant in public practice. I don't know why they don't just call that a CPA. And then you have I guess because in some cases you don't have to be a CPA, I guess, if you're not giving any assurance, no report, I guess you don't have to be a CPA, but generally it is. And then you have the intended users. Okay. And they go on a bit here, guys, with some generic discussion of the SARs types engagements. I don't want to sit here and roll you through all this. I think that this starts to go on a bit. So let's just go ahead and let's take a look all the way over here at this first question for us tonight. See if we understand some basic things about the statements on standards for accounting and review services. Okay, guys, let's go ahead and wrap up our selections. We're going to move on from this question, and most of us got it right. If you take a look at the results here, the correct answer is D, which everybody but I think one person selected. And when you take a look at this, they say, well, when do the SARs apply? And type to client prepared statements without modification? No, we just basically are sitting here and acting like a printer, right? Provide a client with financial statement format that does not include dollar amounts. Hey, we suggested they use something. The SARs doesn't apply. Okay, proposed correcting journal entries. And this sound to me that it was more in the realm of what, a few correcting, adjusting entries. But you can eliminate C because D is so firmly in the category now of requiring that we follow the SARs, using information in general ledger to prepare the statements outside of the accounting. In fact, they even called out one of the engagements that we were saying is falling under the SARs, which is a preparation engagement. Okay. Okay, good. Let's go ahead then and let's jump ourselves now. The next several modules are going to follow the engagements that we've talked about: preparation, compilation, review of contemplated full 12-month statements, and then we'll talk about review of interim statements, and hopefully we'll get through all that tonight, but if not, we may have to wait till next time to get that last one. Okay, but let's go ahead, and that's what I'm thinking is the possible way this will play out, but let's just see. So we're going to come down and we're going to start out talking about preparation. Okay, and in a preparation, we do have to establish an understanding with the client, and we have to establish an understanding with a written engagement letter. So guys, every engagement has to have a written engagement letter. When I say every engagement, I mean every engagement in the accounting world. If you ask somebody to marry them, you don't have to send them a letter, but every engagement in this kind of setting is going to require a written engagement letter. And we talked about engagement letters, I want to say, for audits way back in audit 1, audit 2, maybe. Okay. But what you're going to see is the type of things that are discussed in the engagement letter are common across all engagements. Okay. So let's just go ahead though, and you can make a high-level flashcard, even though we had a more detailed flashcard from audit 2 as to what goes into an engagement letter. We have what is the objective of the engagement, what is management's responsibility, what is the accountant's responsibility, limitations of the engagement. And I don't know why they didn't put this here, but I'm going to add a little box here, which is no report. You will make sure that they understand that there is not going to be a report associated with a preparation engagement. That goes into the engagement letter. And then the agreement of management, that each page of the financial statements will include a statement indicating that no assurance is provided on the statements, or then you will have to issue a report that will be disclaiming any assurance. Okay, so they need to put no assurance on each page when you're doing the preparation. And if they refuse to do that, then you're going to say, well, guess what? Then I'm going to have to issue a report that says that there's no assurance. And that report could then take the format of a compilation report. Okay. Okay, good. Go ahead and flashcard those things that are in the engagement letter. You should continue that onto the next page. Okay, so I asked you the flashcard, but continue that flashcard for the few items that kind of tailed off to the next page, which is management is responsible for the identification of the applicable framework, and that would be called out in the engagement letter. And if there are known departures from the applicable framework, they would have to tell us that, or if they plan to omit any disclosures, that would also have to be in the engagement letter. And we're going to see that it is okay to prepare statements that omit substantially all the disclosures. That is something that we are able to do, but we would want that covered in the engagement letter. Okay. Now, I get a little annoyed because Becker seems, I don't know, they just kind of have this fetish to show you the entire engagement letter. And, you know, of course, you see something in your CPA review book, then you think, oh, I better read this. Okay, you don't have to worry about this. I don't know why they need to give you this entire report here. And I think maybe somewhere Garrity says, memorize every report. And I think that's why they end up putting it in there. So, because if he can't tell you that, if they don't give you the report, so because he tells you to memorize the report, they got to give it to you, which to me, who's going to memorize every report? Can you imagine doing that, or memorizing the engagement letter here? So you don't have to memorize it. You do want to flashcard the key elements that I gave you up here. You don't have to memorize the letter, but I do want to point out here, notice it says in there, which they left that off the list, you would say in there, no report. Okay, we're not going to issue a report. So you come over and let's see what, you know, is going to allow us to do a preparation. Okay, what are the requirements? And we do have to have knowledge and understanding of the entity's reporting framework. Okay, so when we prepare the statements, okay, the accountant should ensure that a statement is included on each page of the financial statements saying that no assurance is provided on the financial statements. Okay. And then examples of statements that could be placed on each page: no assurance. These statements have not been subject to audit or review compilation, but that's going right on the statements. Again, there is no report. Okay. If the accountant is unable to include that statement, then you're going to have to now come up with some way of attaching a disclaimer onto those statements to say, hey, there's no assurance provided, or flip over to a compilation in which you know you have to give a report or withdraw. I find it interesting in that even though a withdrawal from an engagement is sort of like the atomic bomb of solutions when you're doing an audit, they always say, well, if at the end of the audit they don't give you the representation letter, you would withdraw. Well, that would be a good way to go broke, right? Because you do the entire audit and then they don't give you the management rep letter. You've done all the work already. Now you're going to withdraw. That's why you put in the engagement letter of a audit, you will be giving me a management rep letter at the end. So when they refuse to sign that at the end and they don't want to pay, you could take them to Judge Judy and say, well, you see this four corners of this engagement letter, this is the terms of our agreement. And they agreed to give us this, then they refused. And our standards are that we potentially have to withdraw from the engagement if they don't give us the management rep letter at the end. Where I'm going with this, and kind of twisting my way down to it, in a preparation, often, and we'll see that's also the case for compilation and a review, the solution is to withdraw because we're losing some of our options. We're losing the option to what? Disclaim an opinion. We're already disclaiming something we don't like is happening because we're not giving any opinion. We're disclaiming an opinion. We're not giving any opinion. In a review, you're not giving an opinion. There's no opinion to qualify. So you'll lose some of your intermediate steps. And now you're either going to, you're probably going to have to withdraw from the engagement if they won't let you follow the procedures. That's why there is no scope limitation option, I guess is what I'm trying to say here. If they limit your scope, it takes you almost immediately to the withdraw solution for scope limitations. Okay. All right. Let's just go ahead though, and let's take a look at if we have a financial statement prepared on a special purpose basis. Okay. And note that when we talk about special purpose basis for example, cash basis, tax basis, something like that. The account should include a description of the financial reporting framework on the face of the financial statements or in the notes when preparing the statements in accordance with the special framework. So they'd want you to call out somewhere that they're using the cash method, let's say, okay? If there is some inaccurate information, so now they tell you revenue is $1 million, but for some reason you realize, no, that is not correct for whatever reason, okay? Not that you're doing procedures to figure that out, but it could happen, right, in the preparation. If the discovered information is incorrect, incomplete, or unsatisfactory, the auditor should obtain additional revised information from the client. And if they, can't give you the revised information, then you should disclose a material misstatement or misstatements in the financial statements or withdraw. And they're saying, hey, you can disclose somewhere, and now you're probably going to have to attach some sort of reporting on top of that, calling that out. And if you can't do that, the only thing you have left is withdraw. You can't say, well, I'm qualifying my opinion or something, because there is no opinion that's being given. Okay, so that's why withdraw, you're seeing that suggested as a solution a lot more in these areas. Now, as I sort of alluded to earlier, financial statements that omit substantially all disclosures, and so it is okay to do this. May prepare statements that omit substantially all disclosures as long as the accountant discloses such omission either in the financial statements or with an accompanying disclaimer, and the accountant's professional judgment such information was not being withheld to mislead the users of the information. Okay, and so you can see the nature of the type of disclaimer that would be provided if the financial statements omit substantially all disclosures. So it's okay to go ahead and issue statements that leave out the footnotes, let's say, but you would have to you would have to warn the users of the omission, and you'd have to be satisfied that it was not being done to mislead any users of the financial statements. Okay, and then finally we get to the documentation here, guys, and I always ask you to do flashcard documentations because it's usually a nice summary of what we have to do here, right? Which is we have to get the engagement letter. We'd have to provide a copy of the financial statements prepared by the accountant. And then if we did find any issues, what were they and how were they resolved? Hey, we found that the revenue wasn't stated correctly. We got corrected information and they fixed it, or they refused to fix it. And so we provided a disclosure warning to the users that there was some information that didn't seem right to us. Okay. Okay, good. So that takes us through preparation. Let's keep going now to compilation, and we're going to see a great deal of similarity here now between preparation and compilation, with the primary difference being that in a compilation, in a preparation, there's no report. In a compilation, yeah, we're going to have to issue a report. And so we're going to have to understand some of the elements of the compilation report here. Okay. Other than that, it is very similar. Okay. And you can see that we have to have the engagement letter, and you can see the objective of the engagement, management's responsibility, accountant's responsibility, the limitation of the engagement, what is the applicable framework, and then what? The form and content of the report. Where is it? Right here. The form and content of the report. That's what I was looking for. Okay, so we are going to have a report, and so we're going to have to call that out in the engagement letter. And again, I can't quite understand why they got so enamored with showing you the engagement letter again and again and again for every engagement. But since they bothered to do that, the main thing I want to point out to you is, yeah, now we're going to talk about our report because we are going to issue a report. Notice in the preparation engagement letter, there was no contemplation of a report. Okay. Okay, good. Now we come over, and as we said for the preparation, yeah, we have to have knowledge of the industry, okay? And then the key step right here, guys, and let's flashcard this, that we must do in a compilation, because sometimes maybe the financial statements in a compilation have already been prepared. They're already there, but they want to somehow use that externally, and the external parties, the users, that third party, right? And the third party relationship has said, I need something. I need some reporting from an accountant. Okay. So now you're going to give a report and you're not going to provide any assurance, but it's kind of like, I don't know. When I grew up, before people were as gentle, my parents used to say things to me like, don't be stupid, you moron. Okay, so that's what we're basically saying here, is that, you know, CPAs just can't be irresponsible and just say, okay, here's the report, let's go have a beer. Okay, so you're going to have to do something. Okay, so the minimum requirement is that before issuing the report, okay, the accountant should read the compiled financial statements and consider whether they are free from obvious material errors. For example, this is probably a silly one, but let's say you're looking at the balance sheet and it doesn't balance. Okay, that's an obvious error. I mean, don't issue a compilation report and then you look at the balance sheet and assets don't leave liabilities, stockholders' equity, or net income doesn't properly roll to the statement of retained earnings. The hell's going on? Okay, so these kinds of things are the things that they're saying, hey, you know, you should probably figure that out as an accountant. Okay, so go ahead and flashcard that. That is the minimum requirement that you have to do. Okay, now that, by the way, I sometimes get students to say, well, you know, in our firm we do compilation, but we have to, and they start calling out different things. Well, there's nothing in the standards that say you can't do these things. It's simply saying you don't have to do anything more than this, right? Okay, but that doesn't mean that you absolutely, you're not forbidden from doing these things. Okay, now you come over and you just don't have to do them. You come over and if you discover that the financial statements may be inaccurate or incomplete. Okay, so if you discover the information is incorrect, incomplete, unsatisfactory, then you will ask the client to revise the information. And if the client refuses to fix that, withdraw. Okay, so again, you're giving them a chance to fix the thing, right? But if they don't fix it, you're kind of stuck. There's no check down. I can't say, okay, well, you know what? Now I'm going to qualify my opinion. Now I'm going to disclaim an opinion. Now I'm going to give you an adverse opinion, because you're not giving any adverse. So you know there's a problem. They won't fix the problem. You look around and you go, I don't have any other solution. I guess I have to withdraw. Okay, so flashcard that. Now, when you look at the documentation in a compilation engagement, okay, let's just take a look in flashcard, because we're a little bit, I guess I'm a little bit obsessed with flashcarding documentation requirements. The engagement letter, a copy of the financial statement, copy of the accountant's report. Okay. Okay, good. Now you come over, and of course we've said that we have to issue a compilation report here now. And so let's just take a look at some of the key elements in the compilation report and flashcard them. I do not want you to memorize these reports the way I think somebody says in one of the lectures. You don't have to memorize the report, but flashcard the key elements. So include a statement. The financial statement is the responsibility of management. A basically scope paragraph, right, that says we follow the statements on standards for accounting and review services promulgated by the Accounting and Review Services Committee of the AICPA. You know, AICPA is kind of an egotistical organization. I don't know if you realize that. They love to ask questions that include their title in there. So make sure you always know, you know, that when you have to call out their name, because they write your exam and they love to, you know, they love to ask you who's your daddy. the AI, okay, AI CPA, you're my daddy. Okay, so make sure that you always include that you have that on your flashcard. Okay, include a statement that we did not audit or review the financial statements. Now, this is something that we're going to see as a common theme. You always call out the higher level of services and say, we didn't do them. Okay, and that's something that I see common in a question because that's a little confusing. Well, why am I talking about audit and review? I didn't do that. Well, you're calling them out to say that what? I did not do these engagements, these higher level services. Okay, so that means that we are not going to, be checking the accuracy or anything on those statements. Okay, and therefore we do not express an opinion. Well, if you do not express an opinion, what are you doing? You are disclaiming. Okay, that gets a little confusing because sometimes you'll see a question where they'll say, are you disclaiming an opinion on the financial statements? And you're thinking, well, no, because disclaimer comes up when there's scope limitation. But because you called out those higher level of services and you're saying you're not giving an opinion, that is, generically considered what? Disclaimer of opinion. It's not a disclaimer of opinion because you're saying they limited your scope. It's a disclaimer because you're not providing an opinion. So you're going to say, hey, I'm disclaiming. Okay. Okay, good. We come over and when should I provide additional paragraphs? Okay, and additional paragraphs are required if the financial statements are prepared in accordance with a special framework, cash basis. If they have done that thing where all the disclosures are omitted, if the accountant is not independent. Remember, we said that what? Determination of independence is required in compilation, but you're not required to be independent. And if you do those determination and you said, hey, we're actually not independent, then you have to add an additional paragraph that calls that out. If there are known departures from the applicable framework, then you could call those out in the report. And then if there's supplementary information, you should call that out. So flashcard that. Okay. Each page of the financial statements needs to be labeled, see the compilation report, right? What happens? Somebody asks you to compile the statements and you say, okay, but I'm going to have to issue a report when I compile. Oh, well, we don't want the report. Well, sorry, I got to issue it. As soon as you walk out the door, what do? They tear the report off and they start shopping those financial statements somewhere. Well, you want to make sure that each page says that on there so that the users know that such a report exists. Okay. A compilation report does not have to be printed on the accountant's letterhead, however, so you can go ahead and flashcard that point as well. Okay, coming down, you can see the compilation report. Again, I'm not too enamored with reading through those reports because you have the flashcard that I've given you for what some of the key elements are. Okay, good. If the financial statements are prepared in accordance with a special framework, okay, cash basis, whatever it is, then the compilation report should be prepared in accordance with the special purpose framework. Should also include an additional paragraph that indicates the financial statements are prepared in accordance with the applicable special framework. And we kind of already said that in the previous flashcard. When substantially all disclosures have been omitted, the accountant report clearly indicates the omission by including an additional paragraph disclosing such omission. And note that in the accountant's professional judgment, the financial statements were not to be misleading. And so we say that, but then I want to just put a however. Okay, and let's just flashcard this passkey. The omission of one or more notes when substantially all other disclosures are presented should be treated in the compilation report like a departure from the applicable framework. In other words, they can't cherry pick what disclosures they want to admit. Okay, and just leave some in. So they either have to omit everything or put in everything, right? Okay, we don't want them to start to cherry pick. And then the points under 3.4 there that are highlighted, I didn't ask you to flashcard them there because there's a passkey that pretty much summarizes that. Compile financial statements to omit disclosures are applicable if the financial statements would not mislead the users, okay? And the compilation report warns the user of the missing disclosures. That's the key things I want you to flashcard there. Okay, okay, good. Now you come over, and if there are departures from the applicable framework, what are our options? Our options are to disclose those in our report, or what? Withdraw. That's all we got. Okay, we can either call them out or we're going to withdraw. And, you know, let's say we read the financial statements and the balance sheet doesn't balance. And we say, hey, man, come here. Your balance sheet doesn't balance. Okay. And they say, and they look and they look and they look and they can't figure out how to make the financial statements balance. Now, my options are to say, hey, guess what? In my report, the balance sheet doesn't balance. And the implications of that are such that I can't tell you what the implications of something that bad are, right? So in that circumstance, I would probably what? Withdraw, okay? Conversely, let's say I look and I say, you know, you're saying that your revenue was this and your, you know, accounts receivable balance at the end of the year doesn't seem reasonable for some reason, I don't know, then maybe, and I could quantify that somehow, then maybe I still issue the compilation report and I do what? And I call out the implications of this overstated account receivable because I can reasonably protect the user by what I'm saying in my compilation report, okay? So that's what we're saying here. Departure from applicable framework should be disclosed in a separate paragraph of the report and should include disclosure of the effects of the departure on the financial statements if known. If the accountant believes that the disclosure in the report would not be adequate to indicate the deficiencies, he or she has nothing left to do but withdraw. There is no, well, I'm going to give an adverse opinion. I'm going to disclaim an opinion. There is no option like that. Okay. So flashcard that. Okay. Note, guys, this is not called a modification. The word modification, this is not called a modification. The word modification is reserved for when we are qualifying an audit report, for example. So we don't want to start using that term when we are talking about a compilation. Okay. And basically, if you were feeling like, well, how is the compilation different than the preparation? That answer kind of comes to you coming down a little bit. Well, let me look at a couple of things. When the accountant is not independent, disclosure is required. Okay, so you'd have to say that you're not independent, which we already talked about that. Okay, and then you come down, and the big difference between the compilation and the preparation is there is no report in a compilation, in a preparation engagement, whereas in a compilation, there obviously is. Okay. Okay, good. So let's start to take a look at a couple questions now that are in a contemplate, preparation, maybe in compilation. I think maybe it's just compilation in these couple questions. But when you look at these guys, often the format of the question, the theme, if you will, of the questions is they're going to tell you, hey, we're talking about a compilation. We're talking about, when we look at the review section, we're talking about a review. And then they're going to ask you, what is the account required to do? And they'll call out steps that you do in a review, even though they're asking you about a compilation. And the correct answer is going to be what? The procedure that is relevant to the compilation. Or they'll call out procedures that you do in an audit as the incorrect answers. The correct answer is going to be those things that we've talked about that are required for, say, just a compilation, or when we look at reviews, are relevant to review. Okay. All right. So let's just go ahead and let's take a look at a couple of these, and we can practice with that observation and how we would apply it by looking at these next couple questions. Okay, let's go ahead and take a look at this one. Looks like most folks have had a chance to try it. And I don't know, I look at choice A here, which is required in compilation, and we basically said read the financial statements for obvious errors is the key thing you need to do. Now, one person chose B, okay, and maybe you confuse the engagement letter with the representation letter. Engagement letter comes at the beginning of the engagement, right? A rep letter comes at the end of the engagement, and that is required for an audit. We're going to see in a couple minutes when we look at review that it is required for a review. It is not required in a preparation, is not required in a compilation. Okay. C, making inquiries of management concerning actions taken at meeting of the stockholders, stockholders are public companies, is indicating public company. We're not going to compile public company statements under the SARS. And inquiries of management are an audit step, or an audit and a review step that you may make, but it's not a compilation. We just have to read for obvious errors. Applying analytical procedures, we'll see, are done in an audit and done in a review. So the key step that we do in a compilation is read the financial statements for obvious errors. Okay. Read the questions carefully, guys. There's really no reason that I can see of to want to. I can see maybe B if you got the engagement letter confused with the representation letter. I'm not quite understanding. Oh, and then no, I don't understand B because that last part of B, I mean, that goes way off on the playground of, you know, auditing. Okay, will not be used to obtain credit. I mean, yes, no, we're not gonna, that's a little funny there.
Just so you know, for small business loans, it's very common to get a compilation report from a small business. So they are used to obtain credit.
Yeah, and fine. And I'm just like, but you wouldn't get a letter that says it's not to be used to.
No, that's the whole point. That was the point I was making. Since they're very commonly used for that, you wouldn't see that.
Yeah. So I mean, B just went right out of, like I said, went off onto the into the wild blue yonder all of a sudden with that phrase. So I'm not quite understanding why we wouldn't want to pick those other ones. Did I share the results with you? Okay, most of us got it right. Okay, good. All right, let's take a look. That's enough of that question. Let's take a look at this next one. Okay, guys, let's go ahead and submit our selection here. And it looks like just about everybody, there's always that last vote that comes in that messes up my perfect score here. And I always feel it's like somebody just checking the box here. One person chose D, the last person that came in with a selection, and the correct answer is C. And so they tell me financial statements of non-issuer compiled without audit or review by an accountant should be accompanied by a report stating that the scope of the account's procedures have not been restricted in testing the financial information. We're not testing anything. All we're doing is reading the statements for obvious errors. The accountant evaluated the appropriateness of the accounting principles. We do that in an audit. That comes right out of the audit report. If you memorize the audit report, you're thinking, well, that sounds familiar, but do we do that in the compilation report? No, but we do what? Call out the higher level of services and then disclaim that we didn't do those. We haven't reviewed, we haven't compiled, and nowhere in any discussion at all this evening have we said that a compilation includes analytical procedures. I'm not sure if someone wants to chime in with why they thought D was correct. I'm all ears. Okay. Okay, good. So let's go ahead and let's take a look at our next module, guys. But I think you kind of see the kind of mantra there of these questions as we get into these different levels of service. They want to see, do you know what levels of service are consistent with, say, preparation, compilation, now review, versus what you do in the other levels of service, right, including audit. Okay. All right, so let's just go ahead and let's take a look at review of financial statements. And here we're not talking about interim review. We're talking about 12-month review. Guys, forgive me. I'm going to have to this every now and then I get my right eye into that sun and it comes down straight into it. Okay, all right, much better. Okay, so let's take a look now at the review comments, and it is a higher level of service than a preparation and compilation because it results in a limited assurance, and that limited assurance is a negative assurance. Okay, and just to make sure that we understand how a negative assurance is articulated, the review report states that the accountant is not aware of any material modifications necessary for the statements to conform with the applicable financial reporting framework, probably US GAAP, okay, in most cases for our purposes. Now, I gave the example in here before. You know, an audit is a positive assurance, right? So let's say you have a chair that you're going to sit in and the person tells you, well, you know, I'm not aware of any problems that'll cause that chair to collapse if you sit in it. Versus a positive assurance says, in my opinion, there's nothing wrong with that chair that'll cause it to collapse if you should sit in it. Which one are you more comfortable with? I don't mean the chair. I mean, which one are you more comfortable with that it won't collapse? The positive assurance that says, I'm telling you, there's nothing wrong with it that'll cause it to collapse, right? Negative assurance says, I don't know of anything that'll cause it to collapse. Then you say, well, why wouldn't I want a positive assurance? Always. Well, if the chair is 2 inches off the ground, maybe you're not too worried. Okay, if it collapses, I might feel a little funny, but I'm not going to, you know, kill myself. If the chair is, you know, 30 feet off the ground, now you're saying, well, I need to know because I'm going to be sitting in this, and if I fall, I'm going to get seriously injured, so I need a positive assurance, right? So it really depends on the needs of the users, but that's kind of the notion behind, you know, a negative assurance which you give in a review versus the positive assurance that we give in an audit. And then again, in preparation and compilation, there's no assurance. Now, since we are now giving assurance, we're going to have to step up the procedures. We're not going to go as far as an audit set of procedures, but we're not going to go as far back as just read the financial statements for obvious errors, say, which you do in a compilation. So we are going to have to inquire and make inquiries and perform analytical procedures. Those are the key two things that we will base that negative assurance on. We are not required to understand the internal control or assess control risk. Okay, so those are some key things that we're going to take away. We're giving negative assurance. The negative assurance is supported by inquiry and analytical procedure, but we do not have to obtain an understanding. We do not have to assess control risk. Just like in an audit, of course, we don't have to test the controls if we, you know, in a review. Okay, now you come over and you've got to be independent. Okay, since you are going to be preparing the financial statements, not preparing, but reviewing the financial statements and providing assurance, you must be independent. Okay, so any assurance equals what? Independence requirement. If you're not giving assurance, then you don't have to be independent. Okay, good. Now you come over and you take a look, and this is one of the cuter mnemonics. So unlike many of them that I ignore, I'm going to go ahead and fill this one in for you because it's cute, which is you liar CPA, okay, which is very cute, but not particularly helpful, because the key things that we're going to talk about, review requirements, is the inquiry, the analytical procedure, and I do want you to, you know, really start to firmly understand that now for a review, yes, client representation letter is required. It's not required in preparation. It's not required in compilation. It is required. It comes at the end of the engagement. It is required for review. It is obviously, as we had talked about in another lecture, it is required for an audit. And it comes at the end of the engagement. Now, what happens? We have to reach an understanding with the client. So we do need an engagement letter. So engagement letter was consistent across all the engagements, guys. We had to have an engagement letter for an audit, for a prep, for a compilation. Here it comes again for a review, and the themes are, redundant here that we've seen: the accountant's responsibility, management's responsibility, limitation of the engagement, right? Substantial less in scope than an audit, okay? Identification of the applicable framework and the expected form and content of the report, because yes, I probably should have mentioned that we do have a report in a review, just like we do in a compilation. The only engagement that doesn't culminate in a report is the preparation. Okay, so you take a look, and again, I don't know why they waste paper. They could save a couple trees by not including the engagement letter every single time, because it's stupid to do so. Okay, but here's the notion that, yeah, report, just to remind you that we do have a report. Okay, now what I'm going to do here is ask you to make first, since that's the order that the book put them in, a not required flashcard. Okay, things that are not required in a review. Okay, not required in a review versus things that what are required in a review. Because again, remember the approach of the questions is to list off procedures that aren't relevant, but maybe are relevant to other types of engagements, versus the one that is relevant to whatever type of engagement they're asking you about, say a review. Okay, so in a review, we do not have to test the controls. We do not have to obtain an understanding. We do not have to make an assessment of the control risk. Okay, we do not perform audit tests, for example. We don't have I shouldn't say we don't have inquiries, but we don't do verification of account balances. That's an audit procedure. Okay, we do not have to assess fraud risk. I mean, we had a full half-hour lecture on fraud risk in an audit. You don't have to do any of that in a review, and you don't have to communicate with the predecessor auditor, which we saw in an audit. You do have to do that. I guess it'd be predecessor accountant. In other words, somebody else reviewed the statements in a previous year, and now you take over the current year. In an audit situation like that, yeah, you'd have to talk to that predecessor and have specific inquiries that we talked about. In a review, there's no requirement that you communicate with predecessors, people who did a review in a previous year. Okay, so no test of controls. You put also no IC. What's IC? Internal control. No internal control inquiry, nothing. You can just completely ignore the notion of internal controls here. This isn't a full 12-month review, guys. Let me make sure. I probably should have set that up. We're talking about that you're reviewing financial statements for a full 12-month period. We're going to get into interim review in a little while, which is where we're looking at, say, quarterly statements, right? Under that situation, we're going to see that they will ask us to make inquiry about internal control, because what? We're leading up to a year-end audit, and they're saying, well, look, since you're probably going to end up auditing the year-end statements, you might as well start asking about the internal control during those interim periods. Okay. I'm just taking a look at the pages we have left here for this discussion. What do I want to do here? Yeah, okay. Okay, so I'll set it up. Okay. So we've seen that there are procedures that are not required in a review. When we come back from our break from our sponsor, we are going to talk about things that are required in a review. Here we've talked about things that aren't required. Stay tuned for things that are required in review. Okay, so I set it up that way. And we can go ahead and take the break at our regular scheduled time because it's kind of an odd point for a break because we're doing a not required flashcard. In a minute, we're going to come back and start to talk about things that are required in a review. Okay, but let's go ahead and take our break right now. We'll come back, guys, pretty much at 6:30. Okay. And I'm going to pause the recording. Somebody remind me to start it again when we come back. Okay, I think we're rolling again. Okay, great, thank you. Okay, so we did a flashcard of things that are not required in a review. Now we're going to create a flashcard that will talk about procedures that are required in a review. And again, we're taking that approach because that's the way the questions tend to be. They want to trick you into thinking you're supposed to do something in review that would be relevant to an audit, or they want to see, hey, which of the following would most likely be done. And so we want a flashcard that covers that. Okay, so let's go ahead, and there's going to be 3 broad things. 1, 2, and 3. Okay, there's going to be 3 things that we're going to include on this flashcard. Okay, so 1, we have to make inquiries to appropriate individuals. Okay, now they say appropriate individuals, no kidding. I mean, we're not going to ask the guy across the street something about this company. So obviously it's going to be appropriate individuals, but include on this flashcard, because they do try to trick you on this good pass key down here, that inquiry of internal personnel, not external. Okay, so they try to trick you that it's people outside. No, it's internal inquiry. Okay, you're not going to be talking to the client's attorney and all those kinds of things that you would do in an audit. Make sure though that you also include IC inquiry. We already wrote this, but say it again. IC inquiry not required. They like to try to trick you that you have to ask questions about internal control, because we're used to, all over the place, we're always asking about internal control, not here. Okay. Now, that was the first one. So put that on the flashcard. The second one on the flashcard that we are going to include at a high level are analytical procedures should be performed. Okay. Now, I want you to make a separate flashcard as to the nature of some of these analytical procedures. Okay, so let's just take a look. Comparing. Okay, comparing what? Current year statements with the prior period. Financial statements with budget or forecast. Okay, that's why, by the way, prospective financial statements can't be reviewed. Okay, because they are a budget. Right? Okay. Financial statements and relevant non-financial information, ratio indicators, ratio amongst elements within the period and corresponding period. In other words, what? Do a little horizontal analysis, do a little vertical analysis, right? Okay. And comparing disaggregated revenue data. Okay. And you're looking for what? With analytical procedure, you're looking for plausible relationships. Okay, but the key word here was what? The operative word here was compare. Okay, okay, good. And then review other procedures, guys, and just include a couple of these other procedures, which is reading the financial statements for conformity with the applicable framework and obtain reports of other accountants who may have been engaged to review components, right? Remember, we talked about component auditors when we talked about consolidated financial reports, and there's those auditors who audit pieces. If you're in a review and there was somebody that reviewed or audited pieces of the entity that you're doing a review for, then you'd want to read their reports. Okay. Okay, high level flashcard 1, 2, 3, and then a kind of more detailed flashcard about the types of analytical procedures. Okay.
Question. Yeah, in other procedures, it says obtain evidence that the financial statements agree or reconcile with the accounting records. If you're not going to do any vouching and tracing or stuff like that, like exactly what would you be doing?
You'd be looking to see that the general ledger matches the financial statements.
Okay, so you'd go from basically the general ledger up, essentially.
Correct. In other words, there's some sort of accounting system that was behind. In other words, the guy just didn't, go and open up, a bottle of scotch and say, let's see, revenues, 10 million. That's,
Okay.
So there's some accounting system behind what they are claiming to be the financial statements.
Okay, but you're not going down to make sure that the subsidiary ledger matches the GL. You're not going that far. You're just going from the GL to the financial, right?
I mean, that's kind of a high level comment that they're making there, and I would not try to squeeze much more out of it than what we've talked about.
Okay.
But
all right.
If you're asking John, yeah, I would do that too. I would do a quick check to see, here's the financial statements, here's the GL, here are these journals and subsidiary records that roll up to that. I'd want some feeling that there's that. Okay, now, am I going to then say, okay, now from the accounts receivable subsidiary ledger, let me pull a sample of accounts receivable and confirm them? No, not in a review. In an audit, absolutely, but not in a review.
Thanks. I just didn't know how much was enough.
I don't know that the standards, admittedly, I haven't sat there and let me read through the review standard here, the Statements of Standard for Accounting Review Services, to that level of detail, but I don't know that, I doubt that they get into that detail. They're probably letting you say, hey, we want you to do this. How deep you go to do that starts to become a matter of judgment, right? It's almost equivalent to saying, well, here's the appropriate sample size for something. Well, they don't do that either. Okay. But you can you can probably flashcard that one too as part of this review, other procedures. I'm not going to have you flashcard remain alert. Okay. Drink coffee. Okay. All right. Now you come over and they say, and I messed up here. I should have had the fourth element. So I said there's 3. There's actually a 4th one that I want you to include on the required flashcard, of required flashcard review procedures, which is, yeah, now you do have to get the client rep letter. So for preparation, no client rep letter. For a compilation, no client rep letter. For a review, yes, client representation letter. For an audit, yes, absolutely, client representation letter. Okay, and the issues here, I'm not going to go into them because they're very similar to what we talked about for the representation letter in an audit. Okay, and when you watch that lecture, remember I told you, hey, it's things that are hard to audit. That's what you put in the rep letter. So you make them say, you've told us about fraud, right? Because fraud is hard to find because of the concealment aspects about fraud. You've said, you've given me complete information, right? Because completeness is the more scary of the assertions, isn't it? Because, hey, there's this whole world that maybe should be included in the financial statements, okay? So that's the nature of things that go into the representation letter for an audit. And it's a similar thing for the representation letter for a review. Okay, good. And then Becker's fetish with giving us all the letters for some strange reason, as though somebody's going to read that and have any kind of takeaway that would be of value on exam day. Okay, now you come over, and what happens if I can't complete the review? What happens if there's a scope limitation on my review? What should I do? A complete review. Accountants must perform whatever procedures they deem necessary, and if the procedures are not accomplished, the review is incomplete. A review that is incomplete will prevent the issuance of a review report. In other words, what? Withdraw. There is no such thing as a scope limitation in a review. There is no such thing as, well, I had a scope limitation, so let me qualify. What, you're not giving an opinion. Let me move to disclaimer. Now you could, basically disclaim an opinion because there's some problem that you weren't able to be satisfied that they were able to articulate what the problem was. And so you're going to try to, I shouldn't call it disclaim, but you could call out problems, and we'll talk about that. But there's no scope limitation that results in a qualification. So you just have no choice but to withdraw. Okay, documentation should include, and let's flashcard, because now since we're talking about fetishes, my fetish is to sit here, my obsession is to sit here and have you flashcard documentation requirements. So the engagement letter needs to be in the documentation, significant findings and any actions that you took. What were your inquiries? What were your analytical procedures, right? Because we have to do those. Okay, so inquiries, where's my analytical procedures?
Can I ask a question, please?
Yeah, you can. Why did they not call out analytical procedures here? The hell are they doing? 1 second, Serena. Really? Okay. We're going to write that in because you would want to show that you followed the standard and you performed what? Analytical procedures. I don't know why somebody didn't put that in, but you'd want documentation that you performed analytical procedures. Go ahead, Serena.
So if the auditor withdraw, do we still get client representation letter?
Well, you could, if you're withdrawing from the engagement. I'm thinking that, the relationship is such that you stop getting things, a lot of things from them, including money.
Yes.
So, so I don't know. I think it would probably be unusual that they're still going to give you the rep letter, but they could. I mean, the way the representation letter works, just because we didn't talk about that live, I did a recording on that. Basically, what happens is the accountant, the CPA, writes the engagement letter. They say, please give us your letterhead, company. And they print the letter out on the company's letterhead, and then they give it back to them and say, here, sign it. And the client then signs the rep letter. Now, if they're more sophisticated client, they'll probably have their attorneys look at it first. If they're less sophisticated clients, sometimes you run into the problem. So I'm not signing them. And you say, yes, you are, because you already signed a engagement letter that said you would sign this representation letter. And then it's just a matter of kind of talking them down off the shelf, off the ledge. I had situation like that where the director of that House of Representatives Child Care Center, here is my audit I need to do to demonstrate so I can get my freaking license. And now the lady's saying at the end that she's not going to sign the rep letter. I'm like, wonderful. Here goes just my luck. This is my life story, right? So she says she's not going to sign it because I showed that they had a loss for the period. And she says, I'm not signing because I don't like the way you accounted for things. And we showed this loss. But I pointed out to her, first of all, in the engagement letter, you said you would give us the rep letter, and you need to do that anyway. But I also pointed out to her, if you look at how you've operated over the last year, they had these T-bill investments and they had cashed in a couple T-bills to operate. how do you possibly think that you're cashing in T-bills to operate and you're going to show a positive income for the period? I mean, come on. So once I kind of got her past that, she signed it, but I think she kind of whined a little bit because I'm auditing House of Representatives Child Care Center. So you're a House member and your kid is in the child care center and the director is calling you up and saying, there's some guy from GAO over here. I don't like him very much, you know. So I kind of had that, a little bit of that concern. I'm going to get fired over this damn thing. But she finally did sign off on it. So that's the way the rep letter works. It comes at the end and it's presuming that the engagement is concluding in a orderly fashion. You know, if you're withdrawing from the engagement, who knows? There's a lot of things that aren't happening properly at that point. Okay.
Seen engagement letters that almost
I mean,
paraphrase.
Let's say engagement.
No. What I'm saying is I've seen engagement letters that almost paraphrase the management letter, so the management letter doesn't come as a surprise to the client with respect to its scope and detail. That was only I was going to say. That's how you kind of manage that.
Yeah, absolutely. You manage it and you cover your ass in court, right? Because, you know, there's going to be some outstanding billing and you're withdrawing from the engagement because they won't give that to you. And like I said, you know, I was kind of joking, but I see Judge Judy do this all the time. She'll say 4 corners of the contract. And the engagement letter is a contract. So if someone starts saying, well, but no, later on they said that we didn't have to. It's what's in here, right? And so you cover yourself all the more detail you have as to what you're expecting, the more coverage you have if at some point they start to balk on that. Yeah. Okay, good. So I don't know why they didn't mention the analytical procedures there. I'm confused about that. If I'm missing it, somebody tell me. Communications with management and those charged with governance, and we'll see the nature of some of those. Okay, right here. Okay, is part of the documentation. Again, the management rep letter that we've been talking about, and a copy of the financial statements and the review report. Okay, so flashcard those ones that I've highlighted there. Okay, good. Now you come over and the elements of the report, and I want you to flashcard the ones I highlight, okay, of the review report, and note, yes, we call ourselves out as independent, okay. We include a statement that we did not audit the financial statements, which is substantially less in scope than the review is substantially less in scope than an audit. And so we disclaim an opinion. We're not giving an opinion. We're giving what? We're giving a negative assurance. We have management's responsibilities paragraph. We have accountant's responsibility paragraph. So notice, guys, we're starting to borrow some of the headings anyway from the audit report. Unlike where we talk about auditing standard generally accepted in the United States, here we call out the SARs, and there's the AICPA. Want to make sure that everybody knows that they're in charge. Okay, state that the standards require us to obtain limited assurance, okay, that we are not aware of material modifications, okay, and state in there the accountant's conclusion paragraph, okay. Go ahead and flashcard that that we're required to be independent. We'll put that in the report. And then that we will give the negative assurance as the auditor's conclusion paragraph that says we are not aware of material modifications that need to be made nor for the financial statements to be in accordance with the applicable framework. This is a negative assurance. This is a negative assurance. It is not an opinion. So we call it the accountant's conclusion paragraph. Okay, not an opinion. Okay, let's go ahead and let's take a look at a couple questions. Okay, let's go ahead and take a look at this one. Looks like most of us have had a chance to try it. And I'm a little bemused here, I guess, for lack of a better word, by why we didn't get 100% on this. Because we went on and on about what's not required in a review versus what is. And we say, which of the following procedures would an accountant least likely perform during an engagement? And we said there are not what internal control tests, no inquiry over internal controls. Well, observing safeguards would be what would be an internal control procedure, right? Okay. Comparing the financial statements with anticipated budgets, that's an analytical procedure. Inquiring of management is an inquiry. We say we have to do that. Studying the relationships to predictable patterns is an analytical procedure. Question? Okay, come on, guys. Let's take a look at this next one. Let me give you one warning on this question. Read all the choices before you make a decision. Read all the choices carefully, which is the case in every question. But this is a good example why it is important. Okay, guys, I'm going to go ahead and end the poll. And okay, we've got a little bit of scattered results here. 73% of us got it correct. I would have thought the percentage would have been higher than that. I don't know. Maybe my voice isn't traveling quite as well as it should. Okay, but let's go ahead and let's take a look at this one. Most of us got it right. 73% of us got it right. But let's just take a look at this question. And it says financial statements been on issue that have been reviewed by an accountant should be accompanied by a report stating that a review, and I think one person picked A, and that's an easy trap to fall into because yes, it provides limited assurance, but it does not provide limited assurance that the financial statements are anything. It's limited negative assurance that the accountant is not aware of material modifications that need to be made. It doesn't say the financial statements are anything. In fact, an audit provides limited assurance. Reasonable is the limit. Reasonable assurance that the financial statements are free of material misstatement. That's what an audit does. Okay, so A is not correct. Includes examining on a test basis information is representation of management. We don't test anything. We do what? We do analytical procedures and inquiries. Those are not tests, okay? Is substantially less in scope than an audit. We always call out the higher level of service and say we didn't do it. Does not contemplate obtaining corroborating evidential matter or applying certain other audit procedures. Well, yeah, that's true, but it is not in the review report. Okay, now again, it was important to read all of these because when you did, you would have said, if you made the mistake of wanting to pick A, then you would have read B and includes examining on a test basis. Well, no, okay, B's out. But when you got to C, you'd say, well, wait a minute, A and C can't both be correct. Oh, A is not correct. It's a negative assurance, right? That the financial statements, that the account is not aware of material modifications. Okay. All right, good. Let's see. Guys, I'm going to stop there. Okay, I think that's enough. Well, no, let's do this. That's okay. Let's do the review report, okay, because they're going to start to get into elements of the review report, okay, and talk about some things that could happen if you haven't, if you have some problems with the financial statements, how that would affect the report. And then we'll stop and we'll do interim reviews. We'll do the module on interim reviews. We'll finish that next time. And then we'll go ahead and start the final review next time. Okay. But let's just go ahead and let's do this. And an accountant must be independent to issue the review report. If there's an impairment to our independence, we should withdraw. Okay. Now, when you issue the review report, we're going to start to borrow a little bit from our terminology that we have talked about in the in an audit. Okay, so we have what? We have an unmodified conclusion. So that accountant's conclusion paragraph, we would express as an unmodified conclusion when limited assurance has been obtained that nothing came to the accountant's attention to believe that the financial statements were not prepared in accordance with the applicable framework. So flashcard that statement that we've talked about before is referred to as a unmodified conclusion. Just like when we give the positive assurance opinion on financial statements, we call it what? An unmodified opinion. Okay, so when they show us the report again on the next page, that accountant's conclusion here is an example of what kind of conclusion? An unmodified conclusion. Okay, now if we discover a material modification that needs to be made in order for the financial statements to be in accordance with the applicable framework, we call that a modified conclusion. Okay, and if we determine that there is some problem with the financial statements and they're materially misstated, we could give a qualified conclusion. Okay, and that qualified conclusion versus an adverse conclusion would be what? Would be based on the pervasiveness of the problem. And that goes right back to our first lecture, right? Dealing with the opinion. So they're using terms from the audit opinion. Okay. Now, if we express a qualified opinion in the review report, okay, we will, the accounting determines a qualified opinion is appropriate. The conclusion section now will say qualified conclusion, and there will be a description of the matter giving rise to the qualified conclusion immediately before the conclusion paragraph. And I don't know why the examiners think it's fun to ask you if the information comes before or after the conclusion paragraph, but sometimes they do that. So make sure you flashcard where it is placed. I think it's the stupidest thing to test of you in the world, but you know, that's something that I have seen in questions. They get all hopped up on that for some reason.
I have a
Okay.
question. If it's a PCAOB interim review, is it called an unqualified conclusion? Because I think, isn't it for the audits, like it's an unmodified opinion if it's non-issuer, and it's an unqualified opinion if it's an issuer. So is an interim review for a PCAOB client called an unqualified rather than an unmodified?
We don't contemplate doing a full 12-month review of a public company. We're talking about a full 12-month review.
Okay, I see. Okay, got it.
So when we get into the discussion of interim reviews next time, then the PCAOB requirements start to come in, and what we're talking about right now goes away entirely.
Okay, got it.
Okay, yeah. But you're correct, in an audit, the term is unqualified versus unmodified.
Right.
Yeah.
I just didn't know if it carried over to reviews, but forget about it till next week.
Yeah, when we do an interim review, we have a whole different format to the report, because what they start to do there, Kathy, is they try to keep it as consistent as they can with the audit report, because again, remember, we're leading up to the audit.
Right.
And so a lot of this terminology that we're using for a full 12-month review, which is contemplated now, this is standing alone as the product that's going to, the ultimate 12-month assurance in a review anyway, that's being provided here. And there's not this idea that there's something better coming down the road, which would be an audit. It'd be highly unusual to review your year-end statements and then have them audited. That would, I don't know why anybody would do that unless they like to read reports, okay? Because if I got audited, I'm just going to give people the audit report, right? Okay. But notice if you come down here, we have the basis for qualification, qualified conclusion, and then the qualified conclusion. Okay. Now, if it's an adverse conclusion, then it has to have the heading adverse conclusion, and there will be a basis for adverse conclusion that will come immediately before the conclusion paragraph. So just replace the word qualified with adverse if it's adverse. Okay. Now you come over and you look at that report, guys. There's, again, why do we have to have a whole nother report in there just to put the words adverse in there versus qualified? But anyway, okay, then you come over and you have what? You have the emphasis of matter situation. Okay, now remember, emphasis of matter is something that's already disclosed in the financial statements that we are choosing to call out now. We talked about in the context of audit before, but now in our review report, other matters, remember we talked about, are things that are not necessarily included as a disclosure in the financial statements, but that the auditor thinks is of enough significance to include in the audit report. Okay, so in certain circumstances, the accountant is required to include, and those required emphasis of matter items and other matters items. Okay, and you can flashcard that here. Okay, when management revises the financial statements for a subsequently discovered fact, when financial statements are prepared in accordance with a special framework, cash, whatever, you have to call that out. When reporting on comparative financial statements, when the prior period is audited, what does that mean? We audited last year. And then they say to us, well, this year we just want to review. Well, they're saying, okay, you're going to have to emphasize that in the financial statements, because we don't want the users of the financial statements to get confused and think the same level of service was applied to both years, right? So they want you to call that out, emphasize that in your report. Okay. When the account concludes that there's substantial doubt about the entity's ability to continue as a going concern. Okay, and we have to have those words in there just like in an audit. Okay, so we're doing this now in the context of a review, but we would have to have that. And that would be an emphasis of matter because the entity is also supposed to disclose that. So that would be an emphasis of matter item. With respect to supplementary information that accompanies the reviewed financial statements, we said that in the context of an audit, you have to what? You have to acknowledge that information, that it is there. You have to point to it and say that it's there, okay? Now, at the accountant's discretion, an emphasis of matter may also be added to the report to discuss, and let's just go ahead and make another flashcard here, because now this is what you may do this. This is what you are required to here at your discretion. You may want to include an other matters, emphasis of matters for uncertainties, such as subsequent events, significant party related party transaction, changes to the accounting period, okay? Now, again, for an emphasis of matter, as I've said, it's for things that are what? That are already disclosed in the financial statements, okay? You could, if the accountant considers it necessary to communicate matters other than those that are presented and disclosed in the financial statements, then we put the heading what? Other matters on that. And I'm not necessarily asking you to flashcard that notion because that is consistent with what we talked about way back in audit 1. Other matters are things that are not disclosed. Emphasis of matter of things that are disclosed. What I want you to flashcard is when the accountant is required to provide emphasis or other matter and when the accountant can at their discretion. Okay. If they are preparing the financial statements in accordance with a special purpose framework, again, cash, tax basis, the report should make reference to management's responsibility for the applicable framework, include an emphasis of matter that points them to the footnote that describes this other framework. And if it is a regulatory or contractual basis, often that is restricted, and they probably shouldn't have been as dogmatic saying restrict the report, because remember we said if something is prepared under regulatory requirements and the statements are available for general use, obviously you don't restrict those. I mean, they're available for general use. So there is that one exception to when you're preparing for a regulatory, but make sure you are preparing, reviewing statements for under regulatory requirements. Okay, but flashcard those elements there. And let's keep going and looking at reporting on comparative statements. Okay. And what we get into here when we're looking at reporting oh, sorry guys, before we get into that, where am I? Before we get into comparative statements, I want to look about consideration about the entity's ability to continue as a going concern. So let's just take a look at that. And so the auditor should perform review procedures related to going concern if the applicable framework requires management to evaluate the entity's ability to continue as a going concern. So US GAAP does that. US GAAP says, hey, management, you have to evaluate the entity's ability to continue as a going concern. And since we're reviewing the financial statements to see if there are material modifications that are needed in order to be in accordance with the applicable framework, we would be checking to see if what management indeed did do that, okay? Or if the accountant becomes aware of conditions that raise substantial doubt about an entity's ability to continue as a going concern, okay? So flashcard that. You're required to do that if the applicable framework does, or if certain conditions come to your attention, like what? Like they are showing losses period after period or something like that, okay? Now, if after conditions or events that raise substantial doubt are identified, okay, and management plan, the accountant concludes that the going concern is alleviated, we're not required to include an emphasis of matter. If the going concern remains, then as we've seen, we are required to do what? To provide an emphasis of matter paragraph, assuming that the applicable framework requires that, points to the going concern issue, and it must have the word substantial doubt and going concern. So flashcard that. Okay, if accountant determines that the disclosures about the going concern are inadequate, then we are now flipping to what? We're going to have a qualified, a modified conclusion paragraph, or a what? Or an adverse, qualified, I should say, or adverse, because now they're not following GAAP. Okay. Reporting on comparative statements. Let's just take a look at that now. Reporting on comparative statements. Now, just to not to, you know, insult anyone's intelligence, but comparative financial statements will show what? Will show 2022 in one column, and right next to that will show what? 2021. Those are comparative. Sometimes it might be what? Might be 3 years, whatever. Okay. Now, what are they telling us about this? Well, they say current period, where it comes in is if you have differing levels of service or different years, that's where we need to worry about this. So current period reviewed and prior period compiled. So what happens? That would say that 2022 was reviewed, whereas say 2021 was only what? Only compiled. We call this what? We call this an upgrade in service. Okay. And when you have an upgrade in service, let's flashcard what we're supposed to do. When the continuing account performs a higher level of service in the current period, the report on the prior period should be updated and issued as the last paragraph of the current period's report. Now that gets confusing when you say updated. In other words, make sure you're still cool with what you said last year. That's what we mean by updated. Okay, we don't mean that you got to redo the audit or any, excuse me, the compilation in this example or anything, but you just got to make sure that you're still solid with what you had said last year. That's what we mean by updated. Okay. Okay, good. But you include that as the last paragraph of what now would be the current year's review report. Okay. Now, what happens if you have the current period compiled and prior period reviewed? Now, this is considered what? This is considered downgrade in service. We're going backwards now. It can happen. So 2022 was only compiled when what? 2021 had been reviewed. Okay. Now, let's see what they tell us. We should issue a compilation report and add a paragraph to report on the current period statements. The added paragraph should describe the responsibility assumed for the prior period statements. Okay. And the most important thing that happens in a downgrade, okay, and I want you to flashcard that you will have to say, no review procedures have been performed in connection with the review engagement after the date of the review report. In other words, we want to make it very clear to the users that we did not provide that higher level of service after that date, whatever it would be for the 2021 statements, right? Because we've gone down in service. So you have to have that statement. Flashcard that. Okay. Coming over, current period prepared and prior period compiled or reviewed. Again, in the event that the accountants have compiled or reviewed prior period statements but prepared a current period statements, there's no requirement to reference the prior period because we didn't have a report and we don't want to start pointing to some work that we weren't required to report on before, right? And so they just let us off the hook there. Okay, information in column format. Okay, and what do they tell us? accountants may advise client to include a clear indication when the financial statements that have not been audited reviewer are presented in column or format with financial statements on which the accountant has compiled or reviewed the statements, so the user does not inappropriately extend the accountant's compilation report to such financial statements. Okay, so you can go ahead and flashcard that. I don't know. May advise the client. I don't know. Okay, go ahead, flashcard. I'm not quite sure what the hell the standards are doing there, but whatever.
I think they just mean label the columns so that if you're preparing, you know, this one says compiled, that one says reviewed, this one says whatever.
I know what they're talking about, but when they start saying to me that I may advise the client to include a clear indication, that starts to get so gaseous that at some point I'm like, why bother? Is what I'm complaining about. You may want to indicate it clear. Okay, really? And the reason I'm tripping on it a little bit is before they told you, you can't do that. You cannot provide in column or format, okay, statements that were, say, compiled or reviewed with statements that had no auditor involvement, because they don't want the mistake that, you know, those procedures or whatever were extended to a period where you had no accountant involvement. I got that, you know, that one was a requirement that showed courage on the part of the standard setters, and the fact that they have now wimped out to this is why I'm getting a little irritated. But yeah, I think that is probably what they're talking about. Okay, now here they're sticking with their guns. The accountant should not issue a report on comparative statements when statements of one or more periods, but not all, omit substantially all disclosures. So I'm glad they stuck to their guns on that one, because what? You'd put the burden on the user to start parsing through and figuring out what disclosures relate to what year. That's way too much work to give the user the financial statements. They said, no, don't even do that. Okay. Okay. Information affecting previous reports. Okay. Something comes to your attention that affects your previous report. You should basically add in other matters. Should be added to the prior period report that states this was the date of the original report, a statement of the prior period have changed, and the reasons for the change to the original report. You know, maybe you had a qualified conclusion paragraph and then they fixed it, so you want to now change it to what, an unmodified conclusion. You can do that, but you'd have to include these elements to the report saying why you're changing it. Okay. If you have other accountants that were involved in a compilation or review, we call those the predecessors in a previous year. You audited the previous year, I audit the current year, and I want to basically present our reports side by side. Okay. You're going to perform certain procedures to allow me to do that. Okay, so you will read the statements and report of the current period, compare them with the previous period, and obtain a letter from the successor accountant, that would be me, that I'm not aware of any things that should be changed in your prior year's report, compilation, or review. This is very similar to what we talked about when there's a predecessor auditor involved in an audit. However, in that case, we also ask for a letter from management. Here, we're not doing that. Okay. Now, sometimes the predecessor will say, you know, I really prefer that you not present my report with your report. Okay. So that means that the predecessor is not reissuing the report. So now much of the burden starts to fall on what? Starts to fall on the successor accountant. Okay. And basically what you're going to do is you're going to book report the predecessor's report in the successor's report. So a statement that the prior periods were compiled by another accountant who is generally not named, the date of their report, and a description of any modifications contained in the report. Okay. And then you come down and that's it. Okay, that's all I want you to flashcard. Just flashcard those. Okay, okay, good. Come over and take a look over here, reporting when one period is audited. And so current period unaudited, prior period is audited. Okay, that is what? That is considered a downgrade. And in any downgrade of service, you have to call out that higher level of service and say, we have not done any of those procedures since the date of the audit report. Again, we want to make sure that people understand in the downgrade, we haven't done that procedure since the date of the earlier audit report. Okay. Okay, good. Let's take a look at this multiple choice question.
Is there a poll?
Yeah. Yep. Folks are responding to it, so I'm not sure.
I don't see it. It's okay.
Well, which one?
Yeah, I don't have a poll.
Well, other people do because they're
I
responding.
had one.
I'm getting responses. So what do you want, Serena? What
I want A.
Yeah,
okay.
no, I would go for D. Yeah, I didn't get a poll.
Okay. Okay. Well, let's look at this one. The answer here is D. Okay. And which circumstances would cause the accountant to withdraw from a review engagement? The entity does not have reasonable justification for making a change in accounting principle. Well, under the accounting principles, they have to what? They have to have a reasonable justification for making a change. And if they don't, they're in violation of GAAP, US GAAP. And if they're in violation of US GAAP, what do? I give a qualified conclusion paragraph, don't I? I don't have to withdraw. Right? Okay, so no. Okay. What's leading us to withdraw are going to be what? Scope limitations, right? We have options if they have not followed GAAP. We have the modified, we have the unmodified conclusion, we have the qualified conclusion, we have the adverse conclusion, right? So, but scope limitation, they don't give us any drop down. So the entity prepares the financial statements on the income tax basis. Well, we'll just have to call that out as a special purpose framework, right? That's all. The entity requests the accounting report on only the balance sheet. That's fine. That's what? That's a specified element engagement. And we can do that. We can do an audit of that. We can do a review of that. The entity declines to provide us with the signed representation letter. That's a scope limitation. Either give us the representation letter or we are going to have to withdraw. We're not going to be able to issue the review report. Okay. All right, good. Let's take a look at this next question. You seeing the poll this time?
Yep.
Okay, guys, let's take a look at this one because I got a flea here. I don't mean I have a flea like that kind of flea. I mean, I have to go. But the other reason is I'm finding this question a little annoying. Most of us got it right, which issue a qualified opinion, qualified, I should say, a conclusion paragraph if they're not following GAAP, which in this case was to capitalize certain leases. But when you do that, and the reason I'm getting annoyed with this question, when you do that in a separate paragraph. You disclose the departure in a separate paragraph, the reason for the qualification. So D is kind of right too, isn't it? So now I'm thinking, am I missing something? So let me go back. Let's just verify that. Okay, so I think I need to be in the right class.
They're saying it's, yeah, because it's material but not pervasive.
So that's the answer that they get?
Yeah.
Well, somebody's smoking crack. I mean, that's ridiculous because it doesn't, pervasive is the choice. What?
I think
Okay.
their plan is
Okay,
basically
wait,
you need
stop,
to
stop. 02970. Where's the question?
It's 14948.
Yeah,
Oh,
14948.
oh, sorry. Say it again,
14948.
Great, okay. Let me look at it. Now, I'm thinking issue a qualified conclusion, right? D, failure to properly capitalize the material is not present based on the financial statements or material mistake. Management will not capital account shall modify the standard review report and include a qualified conclusion. Yeah, and there's a paragraph that you're supposed to put before it.
Yeah, I think they think it's not enough just to have the paragraph. That's how they're interpreting this.
But you do disclose the departure.
Oh, absolutely.
In a separate paragraph. Somebody in Becker wrote this question when they were drunk. Okay, because that's not a good question. Okay, they need.
Could
to
be one
start-
that got rejected from the exam too.
No, this was not on the exam. This was a question that was previously in this material, and it used to not be called a qualified conclusion paragraph, and so they had to rewrite that section, and then they got lazy and wanted to just take the question that was here, which before it said would give an adverse opinion was the first choice, which was wrong because there was no such thing as an adverse conclusion paragraph or a qualified conclusion paragraph. So they got lazy and they just changed that one first choice to make it correct. It used to be that D was correct, that you would disclose a departure from GAAP in a separate paragraph. That used to be the correct answer because they didn't give a name to the description. They didn't call it basis for my qualified conclusion paragraph before. And then, you know, the person got even lazier and wrote a stupid ass explanation to D. So that's what happened. So, okay, so I don't like that question, obviously. Okay, guys, I want to stop there because I got to run. We will pick up with module 6 interim review next time, and we will go ahead and start the final review material next time. So make sure you're getting that book ready so we can start to go through that. Okay. All right, guys. Have a good rest of the evening.
You too, thanks.
Thanks for your patience.
Thank you so much.
Okay.
Thank you. Have a good
Bye.
evening.
Bye-bye.
Bye.